Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Healthy but moderating, it's jobs day in America. Economists expect it to be the last report before tariffs start to bite. The stalemate thaws. China says it's evaluating the U.S.'s overtures on trade talks, and futures push higher. But tech renews tariff fears. Apple and Amazon failed to ease concerns, bracing for the tough road ahead. Now, even though Apple and Amazon are lower in the pre-market, we are still in the green this morning. In fact, we are on track for a 9th straight day of gains. We've already put 8 of them in this morning. We're higher by about 1/4 point. It's the best 8 days since 2020. You can see NASDAQ futures underperforming, little change because of Amazon and Apple earnings. When it comes to this bond market, it was yields higher as much as 10 basis points for the front end. We come off of that a bit this morning. Perhaps it was the ISMs yesterday. Look, it wasn't pretty, but it wasn't as bad as expected. Lower by 1.5 basis points. Your 10-year yield at 4.19, lower by 2 basis points. We're gearing up for jobs day, 8:30 a.m. The expectation is 138,000 jobs. All right, let's head over now to Valerie Teitel, who's got you some stocks to watch. Good morning, Val.
Good morning, Danny. Happy Friday. Happy Jobs Day Friday. Let's check in on how those Mag 7 stocks are doing after they reported late last night. Amazon and Apple both to the downside. These could be the first of the Mag 7s to actually fall after their earnings release for this current quarter. Amazon giving a disappointing forecast, and Apple upsetting on their China revenue. And also, investors did not like that they might lose nearly $1 billion in the current quarter due to tariffs that did not assuage investors' fears. Let's stay in the tech sector and move on to the digital payments company Block. Take a look at this movement, Danny. They are losing 1/5 of their value, down 22%. They gave a profit forecast that disappointed investors, and they're suffering from some downgrades from across the street. Let's end on the stocks to watch this morning. We have oil majors reporting this morning. Chevron and Exxon are the ones to watch. Will their production plans be changed at all due to the recent plunge in oil prices? Keep an eye on their buyback plans as well.
Valerie, really appreciate it, and we'll catch up with you later in the hour. That is Bloomberg's Valerie Teitel. Also in this hour, we'll be speaking to Sam Lynton-Brown of BNP Paribas, Citi's Veronica Clark, and Joel Kulina of Wedbush Securities. Now, markets have staged a stunning comeback since April 2nd, so-called Liberation Day announcement. We're now just about 1% away from that level, actually 0.5% away from that level. And it's been the classic rally that we so have come to expect to experience, big tech and cyclicals outperforming defensives. Joining us now is Sam Lynton-Brown, head of global macro strategy at BNP Paribas. Sam, always fantastic to see you. Happy Friday to you. Do you think that this quite remarkable turnaround, this risk-on rally, can sustain itself?
Good morning. Thank you for having me, and happy Friday. We think positioning has really played a major role in the moves that we've seen. The proprietary quantitative positioning indicators that we run at BNP Paribas signals that a broad range of investors got sort of too short US stocks. So we think what we're seeing is more fundamentally a technical positioning squeeze. So the question then I suppose one should ask is, well, when do you fade it? Where do you fade it? Here I'd point to the currency market. We think that the squeeze that we've already had in euro dollar lower, the sort of retracement, that's a fade. That's a fade.
So is the more telling signal then from Sam, from what the bond market and what oil is telling you? Because I'd say it feels like cross-asset wise, we're quite disjointed at the moment. Stocks have this remarkable 8-day rally, but we're still looking at WTI below $60 a barrel. You're looking at 10-year yields that are still something like 4.2%. Is that the better indicator that seems to be telling you something about the dire situation of growth?
At a time where there's so many cross currents, as you say, different markets seem to price in different backdrops. And again, I think it really points to how important positioning is at driving these markets at the moment. If you look at stocks over the month, as you just pointed out, the S&P is effectively flat. So that's saying sort of no panic. In contrast, if you look at the energy market or if you look at the currency market, energy is significantly lower. The dollar is significantly weaker than it was at the time of the Liberation Day announcements. I think for the bond market, that's where the pricing here is very difficult for the market to really grapple with, because you have, in some respects, a bimodal distribution. There's a scenario where tariffs get rolled back. US growth slows, but not to the point of recession. Inflation is high because of tariffs. And the Fed actually don't cut rates. They leave policy on hold. They leave policy stable. That's one scenario. The other scenario, though, is one in which tariffs don't get rolled back. US growth slows significantly. We enter recession, and then the Fed cut a lot. And I think that when you mention 10-year Treasury yields at 420, we're caught between those two scenarios.
So what do you need to wait for that to happen? This is an administration that has used uncertainty to their advantage, they say, for negotiations. Will we really get more certainty? How does this narrative resolve itself?
I think for the bond market, what we've learned over the past month that's important is the US administration appears to have a pain threshold in treasuries. If we go back 6 weeks ago, the market was probably more focused on a pain threshold in stocks. That proved to be wrong. If you like, sort of the strike on any S&P put from the administration was quite low. But what we've seen is on bonds, it might actually not be very far away from where we currently are. I say that because we had the 90-day pause of reciprocal tariffs that followed 3 days of a significant sell-off in the Treasury market, 60 bips in 3 days from the 7th to the 9th of April. I also say it because we saw that the dial back of the more hawkish language towards China and towards Powell last week, Monday, came following 30-year Treasury yields getting up towards that 5% level. So I think that the market takes some comfort, if you like, and perhaps that's contributing to the squeeze we're seeing in stocks, that the administration seems bond sensitive.
So then how big of a concern is it to hear from Japan's finance minister just overnight, Sam, saying that the country's massive holdings of U.S. Treasury, which is the biggest of any foreign entity, could be used in negotiations? How big of a threat would that be for the bond market if you do get the Japanese starting to sell their bonds as some sort of negotiating tactic with the U.S.?
I think that's unlikely. There's been a lot of focus in the market recently on whether or not reserve managers have been liquidating treasuries. There's really no data to suggest that's happening in any of an accelerated fashion versus history. I think for global investors, less on the reserve side, more on the institutional side, the question is less about liquidation of treasuries. It's more about, will the marginal dollar over the next decade be allocated to the US in as significant a portion as it has over the previous decade? And our view is no. We think that we're going to see more money allocated in particular to Europe. The Trump sort of inspired or at least accelerated shift in Europe towards more spending on energy, on infrastructure, on defense, that's really here to stay. And that's going to significantly increase bond supply in Europe and support growth over the next 5 years. That should lead to some capital reallocation and is constructive in the medium term for Eurodollar to go up.
Hey, Sam, before we let you go, I just want to get your thoughts for 3.5 hours time when we get the U.S. jobs report. What's the bigger risk for this market? One that surprises with strength or weakness?
I think for the market, the bigger risk is weakness, because as you alluded to in the opening remarks, the consensus in the market is that we're going to get a pretty solid print today, 138K median consensus according to Bloomberg. Our view is 135K, not too different. That's in the middle of the range at the moment between the break-even level of payrolls that we think is between 100 and 150. So this is data that should mean the unemployment rate's stable. I think if we were to see a quicker deterioration in some of the tariff-impacted industries than economists are expecting today, then that could lead to the market pricing in a much quicker pace of Fed rate cuts, could lead to some of the strength we've been seeing in US stocks challenged, could lead to the dollar resuming its weakening trend, in particular versus euro and also the other low-yielding currencies in Asia.
Let's see what happens with almost already 4 quarter points cuts priced in so far this year. Sam, thank you so much for joining us this morning. Enjoy the rest of your Friday and your weekend. Sam Lynton-Brown at BNP Paribas. Let's get you some other top stories now that are trending on the terminal this morning. Online retail platform Temu is changing its business model in the wake of Trump's tariffs. It's moving away from cheap Chinese imports, and instead it's recruiting U.S. merchants to sell their goods to American consumers. Temu says prices for Americans will be unchanged. And Japanese Finance Minister Katsunobu Kato says the country's U.S. Treasury holdings could be a negotiating card in trade talks with Washington. He did qualify. Whether or not we use that card is a different decision. Japan holds the largest stockpile of U.S. debt held by any foreign nation. President Trump says that he will nominate National Security Advisor Mike Waltz as the next U.S. ambassador to the UN. The move sidelines Waltz, a top aide who drew criticism for inadvertently adding a journalist to a Signal group chat where officials discuss sensitive military plans. Marco Rubio will serve as interim National Security Advisor while keeping his job as Secretary of State. Coming up, China weighs the possibility of talks with the U.S. More on the thaw in the trade standoff. That's coming up next. Stick around on your Bloomberg Brief.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
U.S. Secretary of State Marco Rubio speaking on Fox News. It comes as China's Commerce Ministry said overnight that it is evaluating the possibility of trade talks with the U.S., saying, quote, the U.S. has recently sent messages to China through relevant parties, hoping to start talks with China. China is currently evaluating this. Here with the latest is Bloomberg Managing Editor Kevin Whitelaw. So, Kevin, at least for the markets, we celebrate the thinking of maybe talking about the U.S. Where exactly do we stand with China in American negotiations?
Well, it really seems to be that both sides want to pretend the other one's the one that's trying to start the conversation here. But in this case, I do think that obviously the Trump administration is the one that had put all these, enormously punitive tariffs on first, and they kind of went back and forth. So I do think the Chinese up to now have kind of felt that it's up to the Trump administration to begin those conversations. For the Trump side, they've now trying to have conversations with multiple countries, dozens of countries in some ways, and it's just not clear they have the capacity to do it, in part because ultimately there's only one decision maker when it comes to any tariff deal, and that's the president himself.
Yeah, it's such a problem. And it even goes to show countries like Japan making headlines about getting closer to a trade deal. But Kevin, this was supposed to be the first country where we got some sort of agreement, wasn't it?
It was certainly, they seem to be at the front of the line. But, I think the deeper problem still is that, Donald Trump has articulated several different philosophies and strategies behind these tariffs. And one of those has been, boosting U.S. revenues and to be able to reduce or even eliminate the income tax. Well, if that's the actual idea behind this, and he's been bragging about some of the revenues, you can't negotiate tariffs away. There won't be any deals. But obviously, I think when you're looking at some of the economic impacts, and I think the U.S. consumers are going to first see them related to goods from China, that's going to start playing out over the coming weeks and months, whether with shortages of certain products, whether it's with price increases. That's going to be an enormous problem as people start to say, wait a second, this isn't what we voted for.
Speaking of economic impacts, on one hand, you have tariffs. On other, there's this idea that some of the fiscal excesses will be reined in when we get a budget. We had a proposal from the Trump administration for a 2026 budget. Kevin, what did it look like?
Well, this is obviously very, very deep cuts to domestic spending and a very, very significant boost to defense spending. This is kind of what had been telegraphed. I think actually the defense spending boost is maybe bigger than people had expected in the budget. But what I would say is this. Presidential budgets have never once been passed without massive changes to them. It's just never happened. So this really is a starting point for the conversation. This is going to be extremely complicated to get a budget through Congress. You're going to be dealing with a House where the Republicans have an incredibly slim majority and a Senate where they need to have 60 votes to pass a spending bill. And that means Democrats have to go along with it. There's just no way Democrats are going to sign off on the kind of spending cuts on the domestic side that the president is proposing. So, this is really going to be an extremely complicated set of challenges they have going ahead.
Kevin, thank you so much for your time this morning. Bloomberg's Kevin Whitelaw there. Now let's turn to U.S. earnings, and about 2/3 of companies on the S&P 500 have released results, including some of the big ones. Amazon and Apple were out yesterday after the bell. Apple's analyst call did fail, though, to soothe investor concerns about the cost of tariffs. Here with the results is Bloomberg's Charlie Wells. Charlie, so Apple disappointing.
Danny, this was the thud in tech earnings that everyone was worried about, and it certainly reverberated throughout a lot of this pre-market trading. And I think the issue here was this forward guidance that came through that was very negative. So Tim Cook talking on that earnings call about $900 million in increased costs in the current quarter that they could face thanks to these trade tensions between the United States and China. And we have to focus on China, too. We heard him right there talking about diversifying the supply chain, but you also have to think about sales, right? Sales in China in that earnings report were down 2.3%. And this is a crucial market for this company. So pressure there as well, not sending great reverberations this morning.
Well, it's the difference between them and the other tech giants. When you sell a software, perhaps you can be a little bit more immune. Amazon also fits into the category that it goes beyond software, that they have real impact from tariffs. What did we hear from them, Charlie?
Yeah, so look, they had a pretty solid, report, but it is that issue of retail that we've been talking about. So much of that supply comes from China. They have been under pressure there. But we also have to think, if we're talking software, you need to look at some of these numbers as far as the growth in Amazon Web Services. They grew in the quarter, but it was 17%. That is down from prior quarters. Contrast that with Microsoft. Their cloud unit had blowout numbers, and this just speaks to some of the pressures that Amazon, of course, they're diversified across so many business lines, but they face a lot of pressures, not just on the retail front, but also on the software side. So they're also seeing some pressure in pre-market trading.
All right, Charlie, thank you so much. Yep, both Apple and Amazon are trading lower in the pre-market. Amazon down as much as 2%. I will say, though, NASDAQ futures still holding it together. They are higher by 0.2%, so there's still a lot of optimism in this market around China and a possible deal and talks going higher. That seems to be what's lifting us up this morning. Now, coming up, we're going to take a look at what else is making headlines around the world. That includes President Trump's order to defund NPR and PBS. We're just talking there with Kevin about the new budget plans and the cutback expected from the Trump administration. We'll talk about the public broadcasters and your other front pages this morning. You're watching Bloomberg Brief. Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning and what's making headlines around the world. Now, first up, the New York Times starts with the U.S. ending a China tariff loophole. Now, this is a loophole that had allowed American shoppers to buy cheap goods from China without paying tariffs for imports less than $800, the so-called de minimis rule. Ending the loophole is expected to help U.S. manufacturers that have struggled to compete with low-cost Chinese products. We've heard from the likes of Temu, for example, trying to turn to more U.S. vendors in order to get around those tariffs. Now, next up, President Trump has signed an executive order to end federal funding for NPR and PBS. This coming from the Wall Street Journal. That order stops direct funding to the maximum extent allowed by the law and bars future allocation. He said that government funding of news media is not only outdated but unnecessary, but corrosive to the appearance of journalistic independence. Now, finally, on the FT, France and Poland set to sign a wide-ranging treaty covering defense and economic matters to deepen their military ties. It, of course, comes in the face of Russia's aggression and uncertainty over U.S. security guarantees. The pact will be signed by French President Emmanuel Macron and Polish Prime Minister Donald Tusk on May 9th. By the way, speaking of that, we heard from Der Spiegel, the German outlook, saying that the U.S. envoy told NATO allies that Trump may skip the NATO summit and he may not attend if the 5% spending target is not in agreement and not on reach. Perhaps what part of the reason we're seeing those agreements between the French and the Polish. All right, a quick check on your markets this morning. We are looking at S&P 500 futures moving higher. A disjointed market, though. Looking at S&P basically gaining back all of the ground it lost, save for 1% since April 2nd. But your 10-year yield's still at 4.2%. We're still pricing in something like 4 quarter points, something that would seem to suggest that we're in for a bout of economic weakness, one that isn't reflected in the S&P 500. Bank of America's Michael Hartnett writing this morning that markets are pricing for a more tariff-friendly stance, but it is payrolls that hold the key. If they are weak, that's when things will crumble. Now, coming up, U.S. employers are forecast to have added 138,000 jobs in April. We got just in about 3 hours' time, we'll get your U.S. payrolls report. We're going to catch up with Citi's Veronica Clark to talk about what she's expecting. This is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Healthy but moderating. It's Jobs Day in America. Economists expect it to be the last report before tariffs start to bite. The stalemate thaws. China says it's evaluating the U.S.'s overtures on trade talks. The statement pushes futures higher. But tech renews tariff fears. Apple and Amazon fail to ease concerns, bracing for a tough road ahead. Now, even though the tech giants are dropping in the pre-market, we're higher across the indices in the future session. Your NASDAQ 100 is underperforming because of that, but we've had 8 sessions of gains, more than 8.5%. That's the biggest gain for 8 days since 2020. Does today make it 9? A lot of the tariff moves unwinding. For your bond market, it was yields pushing higher yesterday, but again, that eases somewhat this morning. We're lower by more than 1 basis point across the curve. We're at 420 on your 10-year yield. Let's get some stocks to watch this morning. With that is Bloomberg's Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start with a check on those Mag 7 stocks and how they're acting after earnings. We got Amazon to the downside, losing over 2%. They gave a tepid forecast and also showed a slowdown when it came to their cloud business sales on Amazon Web Services. So a bit of disappointment when it comes to Amazon and how they're bracing for the tariff battle ahead. Let's move on to Apple. A little bit of the same story there. Shares are falling in the pre-market. Tim Cook warned about a $900 million hit to their bottom line on tariff costs for the current quarter. They also had a soft number when it came to their China revenue. So we're down nearly 3% now on Apple shares. Let's end with the leisure sector. Airbnb on the downside. They are warning about a booking slowdown of the ahead, perhaps maybe some sentiment about consumer spending slowing down. We're seeing Airbnb shares fall around 4.5% in the pre-market.
Valerie, thank you so much for your roundup and your work this week. Bloomberg's Valerie Teitel. So those are the individual stocks, and we're going to get the data in just about 3 hours. April's jobs report. Economists forecasting 138,000 jobs added. Bloomberg's Michael McKee joins us now. So, Mike, 138, what else are we expecting?
Not a whole lot. Michael Hartnett was saying that the jobs numbers are going to be the decisive figures for the Fed, but not this month. We're expecting 138,000, as you mentioned, and unemployment unchanged at 4.2%, because basically all the tariff stuff came out just at about the same time that the survey week was being held for the April payrolls report. So companies probably didn't have a lot of time to adjust. We're not going to see much difference in terms of average hourly earnings. And average weekly hours aren't expected to change, but this is a number to keep in mind as we go forward, because companies are probably more likely to cut back on hours before they start cutting back on people. And if you see that, it would be a sign of a slowdown. Now, the good news for the, I don't know what, I guess for the administration, if the number comes in stronger than expected, it wouldn't be a total surprise, because 6 out of the last 12 months, including the last couple months, we have seen the payrolls number come in stronger than anticipated, or right there. And it's a little bit unusual, but it is at least a trend that is in favor of a stronger economy and shows that we were fairly strong coming into this year.
So if we don't get the bite of tariffs in this report, because as you say, the survey was done right when Liberation Day was happening, what does that mean for May and June? What happens to those numbers? Well,
we're anticipating we're going to see a reaction in May and June. The question is, how fast do maybe people let people go? What we do see is in the Indeed.com job posting listings, a continued drop. When Donald Trump started in office, the kind of green line there, we saw Indeed job postings start to fall. And the red line there is where the Liberation Day was. And then the survey week is outlined in white. And you can see since then, we've seen a rapid decrease in job postings. So companies are pulling back from hiring. Does that mean that they then start getting rid of people? That's going to be the big question for May and June. Remember Chris Waller telling us last week that he thought that it would be July, the June figures, before we actually had data that showed the economy slowing.
July also happens to be the 90-day tariff pause deadline, too, so it will be an eventful month. Mike, thank you so much for joining, for starting your jobs day with us, Bloomberg's Michael McKee. Now, Veronica Clark, U.S. economist at Citi, also looking ahead to today's report in about 3 hours' time, writing, we see a risk for employment data is tilted to the downside, first from reduced hiring, and then likely from rising layoffs the longer large tariffs last. She joins us now. Veronica, great to see you. Thank you so much for joining.
Good morning. Thank you for having me.
So what is kind of the timeline for what we're going to see in this jobs report and what actually shows up later down the road?
Yeah, I do agree that, if this is a strong one, a boring one, which I think most people are kind of expecting, then it does seem a little bit stale because it's not going to reflect those hiring or firing decisions that were made after the April 2nd tariff announcement. But it is still an important one, I think, because this is a time of year when businesses start to hire a lot of workers. In April especially, it's usually something like 800,000 workers that get hired non-seasonally adjusted, right, in April. And we do know that there was some demand slowing down already, expectations of softer travel demand, those discretionary services. Leisure hospitality is a sector that hires a lot this month. So maybe we do start to see some slowing even before the actual post-tariff impact.
So what is the figure that would indicate to you that it is a slowing that will eventually translate into layoffs?
Yeah, really it's those details of hiring. So if we're seeing that gradual increase in the unemployment rate, that's just, people who are, if you are laid off, you're not finding work. That's what continuing jobless claims tell us. Some of the details of where, if there is weaker employment, is it in sectors that are supposed to be hiring, like leisure hospitality, like construction? And then, that hours worked number will be an interesting one. If you're reducing the number of hours that people are working, that's an easy way to reduce labor costs before then having to lay people off. We're not really seeing the signs of those layoffs yet, but you would maybe watch for it starting really in a month or so.
Well, it's interesting because as Mike pointed out, you heard from Fed Governor Chris Waller saying that July was the time that you might start to see things show up. So are you saying that we'll likely get those figures before July, that his timeline is a bit off?
Yeah, I think the tricky issue is that what we know from uncertainty, from all the expectations of softer demand, is that businesses are going to reduce hiring. And it kind of goes back to those seasonal dynamics where this is a time of year when businesses usually start to hire a lot of workers. You get new students entering the labor force, graduating. This is actually the time of year when we've seen the unemployment rate rise for the last 2 years, and this has already been a labor market where hiring has been pretty soft. I think you might start to see it even before those July numbers.
So what are the figures then that you think likely will cause concern among the Fed that are weak enough to force their hand in terms of cutting?
Yeah, so we've had some guidance even from Governor Waller. It really is the unemployment rate that's the most important statistic. And Governor Waller was saying maybe it's the speed of the increase in the unemployment rate. If we see it going up, 0.2 in a month or 0.3, of course, it was a 0.2 increase that got them to cut 50 in September last year. So that could be part of it. But even if we're seeing, for instance, if we see the unemployment rate today at 4.3%, maybe next month it's 4.4%, it's enough of an increase. And then maybe if we see it in data like initial jobless claims, if those start to rise, I think that's enough for them to be cutting.
Well, it is a Fed, though, much like companies that have been frozen because of tariffs and trying to figure out where they are. So presumably you need something that is big enough to get them to cut. But if that is the case and what you're laying out, is it almost too late at that point if we do have a very reactionary Fed now?
Yeah, it's a really tricky position for them. Because I do think maybe they got a little bit of grief for cutting as much as they did last year, and they were trying to be preemptive, but maybe they didn't need to be. Does that make them overcorrect this time? I think ultimately, if you are starting to see that signs of weakening in the labor market, we still have a Fed that thinks rates are well above neutral, that are restrictive. Yes, we will probably have the price pressures from tariffs, but a lot of the inflation adjacent data, things like home prices or wages, those are still slowing. This seems like a very different inflation than we experienced a couple years ago. I would think they would at least want rates to be closer to neutral still.
I wonder what you've been making of what we've heard from corporate America so far, because it almost seems like a continuation of the soft data being worse than the hard.
Yeah.
Because, for example, you have the big tech companies still spending in CapEx in a huge huge way. You heard from Capital One, Visa, all the credit card providers saying consumers are still spending.
Yeah.
And kind of unknowingness for the future. It still looks strong, Veronica.
It does. It does. The hard data, I think, even especially the activity, the spending data could look strong for another couple months. And we saw the hints of this even in Q1 GDP. We had a big increase in private final domestic demand. But even that, it looks like it might be tariff related. We had consumers spending on cars. We got that in March and even April data yesterday. Car sales were still pretty strong. There was the biggest increase in business equipment investment in information equipment since 1955. Seems like some tariff front loading potentially. You're trying to invest in those goods before you can't get them anymore. So I think we might still see that maybe in April, maybe even May data where there's this front loading activity. But then eventually, if the shipments aren't coming here, then you get that drop off later.
So the pull forward has happened. I also wonder whether you assume that faced with higher prices because of tariffs, whether companies take it on themselves, i.e. we get margin compression, or whether they pass it on to consumers and we get something that looks like a more inflationary environment.
Yeah, it will depend, of course, on the goods, what the elasticity of demand is. I err more on the side of thinking that companies will absorb more of this. There has already been signs over the last year that it has been more difficult to raise prices. We had things like shipping costs actually coming up in 2024, and you didn't really see that passed on. And it's not so clear now, too, that we have a delay of tariffs on certain countries. The tariff on China is just so high that we're going to maybe experience shortages. And so it's not so much that you're passing on a tariff cost, but there still would be price pressure from shortages or trying to find more expensive substitutes. But maybe that takes a bit longer and it's a bit harder to forecast that.
Well, the volume at the ports has dropped off really significantly. How concerned are you that we get something that looks like a 2020 COVID shock in terms of a supply shock?
Yeah. It's we're watching that port data too, but we're not super familiar with it. It's not the data that we watch usually. And there's probably still going to be some front loading from certain countries,
right.
And maybe you would just have then some weird dynamics in certain sectors where we have plenty of shirts maybe, but we don't have bolts and screws. I don't know. So yeah, but you would be worried the longer this lasts that you're getting into those shortage kind of issues after inventories are drawn down.
Yeah, I feel like it's one of those things, maybe to be concerned when one, we're either paying attention to the plumbing of the treasury market, or two, all of a sudden looking at port data.
Oh yes, I watch that daily LA port data every day.
Yeah, it's a sign within itself. Veronica, thank you so much for joining us.
Thank you.
Really appreciate it. That is Citi's Veronica Clark. And later today, don't miss this conversation. Stephen Murin, chair of the Council of Economic Advisors, will be joining Bloomberg TV at 9 a.m. time after the jobs data comes at 8:30 a.m. All right, let's get you some of the top stories that are trending on the terminal this morning. China is assessing the possibility of trade talks with the U.S. This after senior U.S. officials expressed willingness to talk to Beijing about tariffs. The statement signals a potential shift in the tariff stalemate between the world's two largest economies. President Donald Trump is asking Congress for deep cuts to domestic agencies while asking for more money for defense. It's part of the prelim outline of his 2026 budget request that's set to be released today. The president's budget calls for $557 billion in non-defense spending next year. That's a cut of $163 billion from current levels. In the meantime, he is also asking for a 13% hike for national security funding. Elsewhere, President Trump says he will nominate National Security Advisor Michael Waltz as the next U.S. ambassador to the UN. That move does sideline Waltz, a top aide who drew criticism for inadvertently adding a journalist to a Signal group chat where officials discussed sensitive military plans. Marco Rubio will serve as interim National Security Advisor while also keeping his job as Secretary of State. Coming up, Apple results renew fears about tariffs. Joel Kulina of Wedbush Securities joins us next on your Bloomberg Brief. Apple's results failed to ease any of those tariff concerns. And those concerns, I should say, sending the stock lower in the pre-market trade this morning, down by just about 2.7%. Joining us now is Joel Kulina, Wedbush Securities Managing Director of TMT Trading. Joel, great to see you. Thanks for joining us this morning. Just give us your first read on Apple results.
Yeah, first read, I think, sentiment was very cautious into the print, which I feel like it has been the past, several years. But they kind of, unfortunately, services, China both kind of missed the buy-side bogeys. They obviously called out tariffs on the call. I think they pointed to a $900 million potential impact, and some think that's even light if tariffs remain, even somewhat elevated levels. And their guide was just kind of squishy. I think they see the rev growth up 3% at the midpoint. The street was at 4.5% growth. Gross margins were below. And I think the same story for Apple narrative is that the bear thesis is intact. There's just really few drivers to kind of expand the multiple from here. Lack of AI presence, really no innovation on the product front. And it's just kind of an unsexy story within the mega cap cohort.
The bear thesis intact. You sound kind of like the opposite of your colleague Dan Ives, who likes to talk about some trouble in house, perhaps, Joel. Look, just on that. Tim Cook, as we heard there, had been saying, look, we're trying to diversify supply chains. They want to get most of their production out of India coming into the U.S. How do you expect that to go underway, Joel? Is that enough? If they do manage to do that in a timely fashion, does it help relieve any of the concerns about tariffs?
100%. And I think Dan would agree with me too. Like, that's where Tim Cook has been kind of masterful, managing his relationship with the U.S. government, Trump, especially Trump 1.0 and now again in the second term. They've been very proactive in kind of reshifting their supply chain around to reduce their exposure to their Chinese footprint. So again, he's been masterful in doing that. And clearly it's going to help, but time, right? These things also take years to build and to shift things around. It's just not an overnight type of fix. So longer term, yes, but I think with the AI story, still, in my opinion, we'll see what they say next month at the Worldwide Developer Conference. We need to see more innovation, especially in terms of what they want to do in AI. And remember, Apple's taken the path. They're not going to spend massively on AI, CapEx versus all their peers. So that's something people are kind of waiting for them to kind of break through on to really get excited about the story.
I was going to say, Tim Cook even said in the earnings call that they need more time to deliver personalized AI for its features for Siri's Assistant that meets their quality expectations. He needs more time. How willing and how much time is this market going to give Tim Cook, Joel?
Well, I think that the stock is telling you not too much, right? I mean, I still think there's a reason why mutual funds have been underweight the stock for years, and it remains the perennial funding short for the hedge fund community for these very reasons. There's just really a lack of patience, especially what you're seeing, what Meta's doing, and Zuckerberg's been very clear that this 2025 is the most important year for AI, for Meta and the world, in his view at least. And so I think people just want to see a little bit more excitement and energy, and then obviously spending in dollars behind that initiative and focus.
Well, Joel, it's been pretty remarkable, this bounce back we've gotten in equities since April 2nd. And the bounce back has been led by tech. But just given these results, do you expect that tech leadership to become very divided, considering the excitement around Microsoft, Meta, and Alphabet earnings versus what we got yesterday?
Yeah, I think so. It's been a very selective tech rally in the sense where the real buying that I've seen on my platform, has been more towards names that are idio in nature, no secular growth, reduced China tariff exposure. So think Netflix, DoorDash, Melli, if you want some Latin American exposure. Video game stocks have been on an absolute tear as well. And then I think even, 2 nights ago, Microsoft and Meta, we saw some regrossing in those names last night as well. So, and even the software space, large cap software numbers have been fantastic, even before, Azure numbers, SAP, Pegasystems, ServiceNow sounded great. And I think right now within tech as well, semi is sort of a ground zero for this trade war. So we sort of need that to lift, and maybe you'll see some more excitement around the chips. But, where I've been seeing the buying in the semi space, again, very selective in nature. Think Broadcom, Hawktan, announced that massive buyback just a few weeks ago. It's cheap as well. They're diversified. So again, I think there's still people are waiting for the all clear signal to really dust off that offensive playbook. But in the meantime, keeping it somewhat simplistic, it has worked, right? Like being long mega cap for the last 2 years, people generated nice P&L off of that. And now the past, 2 months, again, look at like Netflix, the video games. You don't really have to get too cute and just try to hit singles and doubles along the way.
But Joel, I thought part of the narrative this year wasn't just the animal spirits being quieted down from tariffs, but was just the fact we got too over our skis in tech exposure, that valuations have gotten too high. Microsoft is now up on the year. Meta's down only 2%. Are we not right back in the same place where we started?
I think the big differences right now versus where we were, say January 21st or 22nd, is that positioning is just extremely light. I think Goldman Sachs PB had some color out yesterday. Mutual funds are the largest underweight they've been in quite some time. Hedge fund long short books are massively underweight, the Mag 7 as well on a multi-year basis. Positioning is very clean, and that's a tailwind for the group. And I don't think you can sleep on that. Again, you look and remember when tech really kind of got clobbered back in Q4 of 2022, tech positioning was extremely out of phase, was extremely light. Sentiment was in the dumps, and then the group ended up rallying 19 out of the next 24 months. I'm not saying we're going to see that type of performance ahead, but I think this is looking back historically, positioning as light as it was 2.5 years ago, which is positive for the group.
Hey, Joel, so great to get you on this morning. Please come back and join us again soon. Enjoy your weekend. That's Joel Kulina of Wedbush. Coming up, we're going to wrap up the week with big oil earnings. We also have April's job numbers coming up. Details ahead on your brief. Let's get you set up for your trading day on this Friday. The main event, we have the jobs report coming out. That's at 8:30 a.m. New York time. The estimate, 138,000. Plus, we'll also get some earnings. Chevron and Exxon, they will report before the bell. Also, over the weekend, Berkshire Hathaway will be holding its meeting in Omaha, Nebraska. That happens on Saturday. We have some earnings that happened post-market yesterday that are moving shares this morning. Apple falling 2.8% this morning. The iPhone maker reported China sales that were disappointing. Also warned about the impact of tariffs. We're just talking to Joel Kulina of Wedbush, saying that the bear case remains intact. Amazon also echoing that concern on tariffs. Those shares down 1.5%. Also saying that the related economic turmoil could crimp consumer spending. We also heard from Airbnb a weak outlook for the second quarter. It also cited the economic uncertainties for softer travel demand in the U.S. So a mixed picture, especially on the look forward for a lot of these companies. And as we head to the end of the hour, you are still looking at S&P 500 futures, though, moving higher on track for a 9th consecutive day of gains. We'll see if Jobs Day keeps that intact. And that's it for your Bloomberg Brief. Surveillance from here.